Suppose you have selected your term insurance cover, chosen the policy duration, and entered your income details and completed almost the entire application. And you are just about to make the payment when three more options suddenly appears on the screen. Add a critical illness rider, add an accidental death benefit rider, and add a waiver of premium rider. And the additional cost? Maybe just a few hundred rupees every month. Wow, more protection at such a small price? And it sounds like an obvious deal, doesn't it? But wait, is that rider genuinely providing additional financial protection? Or is it simply making your term insurance premium more expensive? And most importantly, when an emergency actually occurs, will the rider pay what you expect it to pay? Do you really think every rider works in the same way? I am not convinced. So that's why in this video we will compare the critical illness rider, accidental death benefit rider, and waiver of premium rider. And we will understand how their payout works, where the hidden term conditions are, and whether buying independent standalone policies may be a better decision or not. So hi, I am Mariam and you are watching PolicyHub. And let us find out which term insurance add-ons are genuinely worth paying for. So before discussing individual riders, let's discuss one important point, which is rider. So rider is an additional benefit attached to your main term insurance policy where you pay an additional premium and in return the insurer covers one or more specific risk. But rider normally cannot exist independently. It is connected to the base policy and may end when the base policy ends and it lapses or reaches the rider's maximum coverage age. And this is where people make their first mistake. So they see the rider's name but they do not read this exact trigger. Now let's understand waiver of premium rider. So it's commonly known as WOP, and in my opinion this is usually the most meaningful rider available with the term insurance policy, and particularly when you have chosen a long regular premium payment term. So suppose you purchase a 1 crore term insurance policy for 35 years and after a years policyholder suffers a qualifying permanent disability and can no longer work. Income stops, medical cost increases, and at the same time term insurance premiums remains due. Now let me know honestly, during such a crisis, will paying an insurance premium remain first priority? Probably not. If you miss the premium and the policy lapses, your family may lose the life cover precisely when your financial condition has become most vulnerable. So waiver of premium benefit can solve this problem. So when the specified event occurs and the claim is accepted, insurer waives the future premiums covered by the option while the eligible policy benefits continue. And let's discuss the rider that creates the most confusion, which is critical illness rider. Imagine that someone has 1 crore term insurance policy and a 20 lakh critical illness benefit. So if they diagnosed with a covered cancer and the insurer pays 20 lakh, and it sounds excellent, but what happens to your 1 crore life cover after that payment? This is the question most people forget to ask. Critical illness benefit can broadly follow two structures: accelerated benefit and additional benefit. So under accelerated structure, the critical illness payout is taken from the base death benefit. For example, if your life cover is 1 crore and an accelerated critical illness benefit pays 20 lakh, your remaining death cover may fall to 80 lakh. Wait, what? You thought the 20 lakh was extra? That is exactly why the word accelerated matters. Insurer is paying a part of the death benefit earlier because of the qualifying illness, and it may still be useful, but it is not necessarily additional protection. So should you buy a critical illness rider? My answer is maybe. Choose it when the payout is additional. The illness definitions are reasonable, comprehensive, and the coverage continues for an appropriate duration, and the premium is significantly more attractive than a suitable standalone alternatives. Now comes the accidental death benefit rider. Here, pay a small additional premium, and if death occurs because of an accident, family will receive an additional amount. For example, base term cover may be 1 crore. And accidental death benefit may provide another 50 lakh or 1 crore when death qualifies an accidental under the contract. Wow, double protection at teeny cost? And it sounds impressive, but let's examine the real risk. Do not misunderstand me. I'm not saying that accidental riders never pay or are always useless. Some riders are pure accidental death rider. For example, HDFC Life's accidental death, disability, and dismemberment benefit rider provides defined percentages of the rider sum assured for accidental death, specified dismemberment, and total or permanent disability. So, before completing your term insurance purchase, open the rider brochure or policy document and check 7 things. What exact event triggered the benefit? Is the payout additional or will it reduce the base life cover? Does the rider pay cash, waive premiums, or do both? Is there a waiting period or survival period? At what age does the riders end? And does the rider terminate after the first claim? Because rider costings only a few hundred rupees may appear inexpensive today, but when multiplied over 20 or 30 years, it becomes a serious financial commitment. So, objective is not to add the maximum number of riders. Objective is to build protection that actually respond when your income stops or your family needs financial support. Now take out your existing term insurance policy and check which riders are attached to it. And do not just read their names, read the benefit definitions, payout structure, and exclusions. And you might discover that your policy is better protected than you thought. Or you might realize that the rider you have been paying for doesn't work the way you assume. I hope this video clear your all doubts and share this video with anyone who is planning to buy term insurance, because one correct decision today can prevent years of paying for unsuitable coverage. And like this video, subscribe to PolicyHub and stay connected for transparent and practical insurance comparisons. Because at PolicyHub, we do not simply tell you which policy to buy, we help you understand what you are actually paying for. See you in the next video. Until then, bye.